Jessica, it's great to have you back. Happy Friday.
Happy Friday. Thank you for having me.
So I wonder how you're thinking about the model right now. We've been asking questions about the streaming model for literally years. But given what Adam told us and what David said last night, are we in the middle of a corporate shift?
What I like about what Warner Brothers Discovery Management had to say last night is that they're taking a holistic approach to the business, to the content business. Instead of doing a complete pivot like some have done towards streaming, they will monetize content on every platform and maximize their, each piece of content. So it's all of their linear networks as well as all of their digital platforms, including streaming. And David Zaslav laid out the plan to release movies first in movie theaters, which creates an event. I mean, it maximizes all of their revenue streams as well.
I know you've got a buy on WDB, but I'm trying to think back. I think you took an axe to some numbers. Was it last week? Just overall, is that on ad concerns?
We took the numbers down, and obviously we didn't take them down enough. So the big surprise, and probably the reason why the stock is down so much today, is that the company reset guidance, and we would call it a kitchen sink quarter. And we absolutely prefer that approach as to death by 1,000 cuts. A lot has changed since the company provided initial guidance well over a year ago, including the macro environment, but also what they received from AT&T was a lot, the EBITDA was a lot lower than they expected. So there's a new starting point at this point with the new guidance of $9 to $9.5 billion in EBITDA this year, $12 billion for next year. We think they've reset. The underlying premise is that all of the growth in 23 is from cost synergies. They have nothing baked in for improvement in their businesses, which we think is extremely conservative.
So despite the move in Warner Brothers down nearly 14%, you're staying bullish on this name. What about Paramount, though, the opportunity there?
It's a bit of a different story. They've really pivoted towards streaming. They've done well. Their subscribers have done well, but they don't have the breadth and depth of assets that a Warner Brothers Discovery has. This company, meaning Warner Brothers Discovery, has the potential to become one of the most, if not the most important media companies on a global basis. I mean, obviously Disney is there right now, but the asset base within Warner Brothers Discovery on the Warner Brothers side has been underutilized, and I would not make that argument for Paramount. They've really gone through that library many, many times. So they're starting from completely different, in a different space.
Given what we've heard now from Paramount, Warner Brothers, Netflix 2 weeks ago, how would you size up the media landscape and how these companies are performing, especially ahead of a potential more economic slowdown that many are forecasting?
Right. Well, again, I would say Warner Brothers Discovery is operating from a completely different base because they have $3 billion plus in cost synergies ahead. And, our view is that they have very significant revenue synergies from advertising, which is being sold under one sales force for the first time ever. So you have news, entertainment, and sports under one advertising sales force, but also just distribution and their scale will help. Disney reports next week, and we think their numbers will be very positive, particularly on the theme park side. So there are differences within the media landscape. And Fox reports next week as well, and there'll be a completely different story. They've pivoted towards live.